Can selling options, mostly covered calls, turn a losing investment into a winner? It can, but just how likely is it and by how much? That's a tough question, and I'll talk about it in this episode. And I'll give a recent example where this happened to one of my investments, Ford. Let's do the example first, then I'll talk more about turning losses into gains by selling options. I'm going to show a few charts and show my transactions with Ford over the last couple of years. As you can see on this chart, Ford stock has moved down over this time period from around $13 a share to around 10 today. Here's a chart annotated with some of my transactions. I sold a put here for Ford back in February of 2023. It was assigned here April 21st of 2023. Then after several dividends and covered calls here over this time period, it was called away on March 21st, 2025. I was assigned 1,000 shares right here, $12 a share. Then it was called away here at $9.85. So that's a loss of $2.15 per share. I had 1,000 shares, so that's a loss of $2,150 on an investment of $12,000. Not so fast, my friends. We haven't considered dividends or net option premium collected. We get the dividends whether we have options or not, as long as we own the underlying stock. And we do own the stock with covered calls. Dividends lower the cost basis over time, so we'll include those in both cases, with and without selling options. Back to the previous chart quickly. I could have continued rolling my Ford options at the end, right around here, but I chose to let it get called away. You may be wondering why. It had nothing to do with selling options. It was actually in a very good position to roll if I'd wanted to, but I'd lost confidence in Ford as a business. The reason I wanted to own Ford was not happening. I thought it would make more progress in EVs, but sales are slower than expected, and it's still losing lots of money in its EV business. I've lost faith in their management and Ford's ability to be successful long term. I wanted to deploy that capital elsewhere, so I let it get called away even though I could have rolled. I don't believe in owning stocks just for the sake of collecting premium. Most of my gains should come from gains on the underlying stock, not premium. And I need to feel good about owning the underlying business. Now let's move on to a couple of spreadsheets briefly. Each spreadsheet will group the transactions in a different way. Then we'll jump back to a final chart that shows the cost basis and profit loss over time and compares that to what would have happened without selling options. But first, if you're enjoying this content, please consider liking and subscribing. This channel is over 1,000 subscribers now, and thanks so much to everyone that's subscribed. This first spreadsheet groups the transactions by underlying, red, dividends, green, and then these option transactions are blue. As you can see, I lost $2,150 on the underlying transactions. The initial investment was $12,000, and I held it for about 23 months and sold it for $98.50. Doing some simple math and rounding, that's losing about 8% a year. Including dividends helps. Ford paid out $1,530 in dividends over these 23 months. Now I've only lost $620 over the 23 months, which is roughly losing around 2 or 3% a year. Still kind of bad and losing money. Finally, let's include the net option premium collected as well. This includes my initial sold put and covered call, and several covered call credit rolls. The net premium gain was $2,097. So now we've made a profit of $1,477 over the 23 months. Again, we get this $1,477 profit by computing the loss on the underlying, $2,150, adding back the dividends of $1,530 to get a loss of $620, and finally add the net premium collected, $2,097, giving a final gain of $1,477. That returns nothing to get excited about, making approximately 6% a year on this investment. That's underperforming the market indexes significantly over this time period, but slightly outperforming cash in most investment grade bonds. But the main point is a heck of a lot better than losing 3% over that time period. One thing you may have noticed is the odd looking strike price here, $11.82. Ford occasionally has special dividends that change its existing option strike prices to unusual values like this. That happened here, an 18-cent special dividend, adjusting the 12 strike down to $11.82. It also happened on my last $10 strike call, adjusting it to a strike of $9.85. Here's the second spreadsheet with those previous transactions sorted by date and showing how the cost basis goes down over time. When I was assigned here, my cost basis was $12,000 minus the $333 premium I collected from selling the put, that value. Then you can see my cost basis go down over time as I sell and roll covered calls, all the blue lines, and collect dividends, all of the green lines. My final cost basis after collecting a dividend on March 3rd was this number, 8,373. My shares were called away a couple weeks later for $98.50, which worked out to a $14.77 profit. We're moving on to the last chart, which shows a visual representation of the previous spreadsheet. I've converted the values to value per share. The down-sloping blue lines are sold puts, sold calls, and credit rolls. If they were debit rolls, they'd slope upwards and the cost basis would go up, but I had nothing but credit rolls on my Ford investment. The down-sloping green lines are dividends. This first blue dot here is from the put sold. I received that cash 2 months earlier, which is nice. I put it to work elsewhere over the entire 2 years. One thing to consider as you move left on the chart, you have received the cash from these dividends and premiums, so you can invest that in higher yielding cash or new investments. So your return should be a little higher than just computing your return from the final closeout profit. You've had parts of that profit for months or years, and you can and should make that work to your advantage. After my initial put, this is my initial covered call, then a roll, then a dividend, then another dividend, and a roll, and so forth. You can see 2 special dividends here and here, the 2 straight down green lines that happened on the same day as a regular dividend. This straight down blue line is just a roll that fell on the same date I received this dividend. And then here is the final cost basis, $8.37 a share. Then a few weeks later, it was called away at $9.85 a share. Let's compare that with the results with no options. We're going to have to make some assumptions because there's really no way to know what I would have done without options in play. Let's say I would have either bought the stock when I sold the put, which would have been about $13 a share, or when the put was assigned, which would have been slightly below 12. Let's say I would have bought it for 12, which is probably favorable to the no option case. Then let's say I would have sold it for 10 the same day it was called away. I would have ended up losing $470. I spent $12,000 to buy the stock. I received $10,000 when I sold it, and I received $15.30 in dividends over that time. So that all adds up to a $470 loss, which is about $2,000 worse than selling options in this example. So am I recommending you go out and buy Ford stock, do the same thing over the next 2 years? No, I am not. However, if you believe in Ford as a business going forward over the next 5 or 10 years, then you could try it. If you don't believe in the underlying business and don't think its business will do well in the future, then don't sell puts on it or buy it to begin with. As a long-term option investor, the most important factor is your assessment of the intrinsic value of the underlying business of the stock. Option premium is just a means to make a little extra income. In this example, this premium turned a loser into a winner. Let's head back to the questions at the start of the episode and see what we can say about them. Can selling options turn a losing investment into a winner? Yes, it can in the right circumstances as demonstrated by this episode. The underlying can't go down too much over the time period, or you just won't collect enough premium to make up for your losses. Also, it can't crash down too quickly or you won't have time to collect enough premium. Premiums plus dividends can make up for a non-trivial amount of losses over time, and they're a very nice bonus if the underlying has a gain. But you need to set the strikes on your calls and rolls high enough to keep it from getting called away. So how likely is it to turn a loss into a gain with options, and by how much? This is the tough part. Can you count on turning your losers into winners by selling options? No, you cannot. But occasionally you will. And if you still end up losing after collecting the net premium, you'll usually lose a little less. However, that knife cuts both ways. If your underlying turns into a big winner, you'll probably win less because you'll get called away far below market price. See my series of episodes on In the Money covered calls for more details, linked in the description. My hunch from experience is that turning losers into winners requires the right circumstances and is somewhat rare, but not astronomically rare. Sorry for the vague answer, but it's a very difficult question. Selling options and comparing the results to no options and ignoring ties can result in the following 6 outcomes. You can turn a winner into a bigger winner by collecting premium. You can turn a winner into a smaller winner if the profits missed on the underlying's gain is more than the premiums collected. You can turn a winner into a loser if you roll way down after the underlying falls and the underlying zooms upward and gets called away. Try to avoid doing this. You can turn a loser into a winner. This episode, you can turn a loser into a smaller loser with premiums collected, and you can turn a loser into a bigger loser. Again, if you roll way down and then the underlying bounces and you get called away well below your cost basis. How likely are each of these? That's an interesting and difficult question that I might cover in future episodes. That's it. Thanks for watching until the end. Let me know in the comments what you think. Did I get anything wrong? What parts were helpful and what parts not so much? If you enjoyed it, please consider liking and subscribing and have a profitable day.